the last major event, of course, was the crash of 2008, and we are eight years in that now already. So the risk of another negative surprise like that is, of course, rising every day now.
A new silver company for investors, with Keith Neumeyer agreeing to become a major shareholder. Luke Norman, co-founder of Gold Standard Ventures, is the new chairman, and the company has acquired 3 former First Majestic silver properties. To learn more about this must-own silver stock, go to futuremoneytrends.com/silver1. That's futuremoneytrends.com/silver1.
Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and today we're going to have a conversation about what 2017 could possibly look like. And I have on the line here Nico Pantelis, the founder and chief strategist of secularinvestor.com. He's an economist, he's an analyst, precious metals expert, and someone who has a real pulse on the economy, and I'm looking forward to diving into a few topics with him today. Nico, thanks for joining me.
Hi, Kenneth. Thanks for having me again.
Absolutely.
Best wishes for the new year to you and your listeners.
Thank you so much, sir. Yeah, it's been some time since our last conversation, and as we've discussed in the past, I mean, the situation looks dire across the board, and, we have had the Trump effect in the markets, and at least here in the U.S., there's optimism in the air. And I want to get your thoughts here, since we've had Trump enter the markets, what's the situation look like in Europe, if we can get your take on that? With Trump being the leader in the U.S., is Europe as optimistic as conventional Americans seem to be?
So Kenneth, the feedback we are getting from Europeans is that they're still looking very depressed over there, and they're looking forward to what Trump has up his sleeves. So that's also what we are doing, looking to the US and see what's going on over there with you guys. And so what we are looking for this year, which could come around, is I think we could see an uptick or a return in the velocity of money. So that's something not much analysts are looking at, because it has been dropping like a stone ever since the crisis began in 08. So the velocity of money is the ratio between the GDP and the money stock out there. So you can achieve a rising velocity of money or you can pump up GDP, where we think Trump will do his thing and come in with his extra stimulus packages and crank up GDP. And on the other side, I think the money stock will top out, maybe even slightly drop a bit, which in the end will bump up the velocity of money. And this will be inflationary for the system.
So if the money, and I apologize to interrupt you right there, but I wanted to hit this. If the money supply you believe to come down, is that because of debt destruction? Why do you suppose we're going to see a...
I think leveling out is the more accurate way to look at it. I think we see more an uptick in the GDP through the Trump administration. But the money stock, if it's leveling out, I think it's going to be because of the credit creation, which is going to come down a bit. And also money is more in relation in the economy and not so more on the bank accounts. That's the thing we are looking at.
Nico, when it comes to foreign currencies, versus the U.S. dollar, and just how it impacts the rest of the world, and even the U.S. here, I mean, we have the U.S. dollar getting stronger over the last couple years. And, when Trump was elected, it continued to surge. And we have the U.S. dollar almost 1-to-1 against the euro. And I just want to get your thoughts. What implication does a stronger dollar have, with Europe? And, what are your thoughts on it elsewhere around the world?
Yeah, normally a stronger dollar is deflationary. But and that's where I think this dollar rise is putting is hurting the Trump administration at the moment. That's the sound we are hearing from the new government, which Trump is uniting. That these new people in this cabinet are not very happy with the rise of the dollar. So I think we're going to see if he gets in the White House that the dollar will start coming off a bit again. Because they can't have that with inflationary policies.
Sure, and Jim Rickards talks about currency wars and the world essentially wanting to debase their currency for exports. And so would you say that a falling euro has been good for Europe and bad for others? What are your thoughts on that? Excuse me.
It's not that the European economy has been profiting a lot from it.
Sure.
But what you're seeing at the moment is that inflation is picking up very strongly in specific segments of Europe, specific areas like Germany and stuff like that. So we're seeing the size effect of that part, and that's what the central bank like. If the thing starts heating up and inflation is coming, that's precisely what they want. So in that case, it's good for Europe. But I think the US will not stand still and start taking measures about a high dollar and start depreciating it through various measures. But I think, and that again also will be inflationary in the US. When time comes along in 2017. On top of that, if you look at inflationary aspects, you have I think we can see the return of the velocity of money. You will have the depreciation of the dollar, and you have the new rate cycle the Fed has induced, and an uptick in the rates is also inflationary because the cost of capital will go through the system and make life more expensive in the US, and this is also inflationary. So in the end, what we'll see is a return of inflation. We have been combating deflation for many years now since the crisis, but I think Trump will hit the stop button for that one.
Nico, as people get more optimistic on the economy, they are entering equities to a larger degree and selling bonds. This, of course, is causing interest rates to rise. And so many things are dependent on ultra low interest rates, much of which is the $230 trillion of global debt that is dependent on ultra low interest rates. So my question to you is, can the economy allow for investors to get optimistic about stocks and sell bonds? Can that happen without a breaking point?
It can't happen all of a sudden. That's the big thing. They have to maneuver this giant thing in very, very small steps. It's like turning the Titanic around, and the Titanic could hit icebergs all the way when turning. So that's the very difficult part. This system is standing for. Yeah, that's a big thing. Yeah,
sure.
It will be a difficult one to maneuver, but like we've seen how the Fed and the administration is handling things. If you get a new rate cycle and the Fed raises their interest for short-term rates only once a year, that says a lot, I guess.
Yeah, gold and silver are having a great start to the year. And does this give you confidence that precious metals are resuming their bull market momentum, with them ending 2016 and many people questioning if we are actually in a bull market or not?
Yeah, and that's a very strange thing to notice, Kenneth, because if you look at the statistics, gold is up 8% for 2016, and silver is up like 16% for the year. So why people are very nervous and negative and depressed even about the precious metals arena. I don't get that, because we've been in a bear market for like 4 years, and every time when a bear market ends, it ends in volatility, and it's not always the good times are now back and here to stay. It's a very volatile scene at the bottom. So it's normal behavior we saw in 16, I guess.
Yeah.
In my opinion, and I think we can see more of that in the first half of 2017. But like you said, we had again a great start for the year, and if you look at the day we are talking to each other, gold is up over 1%, silver is going up a few percent, even gold miners are up 6% for the UE index. So yeah, it's a great environment, and I think precious metals are sniffing the inflationary environment coming up later this year. That's my opinion.
Yeah. Yeah, no, absolutely. And, we're even seeing, oil go up lately. Yep. Oil's going up strong. And, it's important to notice that, all commodities, or many commodities across the board, are rising.
All commodities are going up. Even the beaten down uranium stocks are getting a bit nowadays. So that says a lot about the whole complex. And
yeah.
Even other assets like for instance Bitcoin is going through the roof. It says a whole lot about what's going to come through the system. I think like the thing we talked about in our last conversation, alternative assets in general, commodities and specifically precious metals are the way to go in this environment. We still think it do, and specifically we are in big favor of gold miners. These stocks are still beaten down significantly, and if with the outlook we are having, I think there's bright times ahead for the complex, specifically gold miners.
Nico, hindsight is always 2020. When you look at the past, it's always easy to say, "Oh, I should have bought then," or it's all this thing. I should have sold at that time, right? But looking forward, it's always rough. What do you do today? But I want to, if you wouldn't mind, maybe give us an idea of what we could see gold do based on what it's done in the past. The kind of returns that people have seen in gold based on what we've seen in the past. We're looking at $1,100-$1,200 gold here. It's in the $1,100 range. What kind of returns could gold go through over the next 2 to 5 years based on what it's done in the past after it's gone through a long bear market?
Yeah. The thing is, Kenneth, we already did this calculation back in 2007, I think it was, and we published that report in 2008 for our subscribers then. And we already had a vision back then that beyond 2015, things could get really hectic or really crazy. And from there on, the gold complex would eventually go to its secular high in a few years. So what we think was a little bit crazy was negative interest rates last year. And we are getting back to normal interest rates from that part, and I think it will be the catalyst for leveling off the gold arena, the gold price, and getting back up to its high. First off, and if it breaks the high of just around above 1900. I think it's up and away, and our target price back in the days, back in 2008, was more or less $5,000 an ounce, and we're still sticking to that. Mm-hmm. So I think we could see that time project, let's say 2020. That's where we are headed, I guess.
Wow. Yeah. Well, Nico, interesting thing about oil is something that I've found rather unique, is that it seems to go in the direction of the market. Oil's up, the market goes up, or oil goes down, the market goes down. There's a strong correlation between the two. And would you say that there is the U.S. equity market dependent on rising oil prices, or is it just a symptom of the economy? Is the economy doing well, oil is up, so, or the economy not doing well, oil's down, and, markets move in that direction too?
I think it's more of a capital market thing, where the money flows, it spreads all over to these risk assets. So if the capital flows in, stocks are up, oil is up, stuff like that, and because like you said, stocks are rising and oil is rising too. In the short notice, it could be, but that is not the longer scene we've seen of the picture we've seen with the drop from above 100 to below 30. With stocks going sideways in that moment.
Right, exactly.
So, let's put it's a short-term capital wave structure, I think, in the short notice. But in the long run, I think oil is running its own course, just like gold is, and I think they are running on inflationary fumes. So I think also for oil, it's going up. It's not staying for long below $50 per barrel. I think in the next years you won't see that price returning anymore.
Nico, we have the Soviet Union back in 1991 that was reporting 3% growth right up until they collapsed. But they were reporting 3% growth, up until the months, which, of course, turned out to be a lie, and the economy was actually truly shrinking. And the precedent has been set for governments to lie to the people for the sake of perception, and we've seen that. And, what do you make of all the phony numbers, from unemployment to inflation ratings to artificial interest rates? Could a major event be on the horizon that, is going to absolutely shock the markets?
The last major event, of course, was the crash of 2008, and we are eight years in that now already. So the risk of another negative surprise like that is, of course, rising every day now. And with the data statistics of governments not always that accurate or manageable in the short run, you always have to, how do you say that? We as analysts, we look at the data, but we look at it in a longer over a longer period. So if things go in the short run, drop or increase a lot above the normal rate of acceptance, then we are not really calculating on that. So we are looking at the longer big picture in statistics, and if on short notice things go sideways, or then we don't look at that as much. We look at other things.
Yeah. Macy's actually just announced that they're going to be cutting like 10,000 jobs and closing 100 stores. That's the largest department store here in the U.S., department chain. And it's another symptom, again, of, technology changing, because people are purchasing things, to a larger degree online. But also, that the economy is just not as resilient as everyone wants to believe. Here's the largest department store dealing with problems and having to cut, and even with all the optimism in the air, we still get news like this. Any thoughts as to either the changes that people are going to have to make based on the technologies that are coming forward, or the thought on the economy? Any thoughts on this?
Oh yeah, you know what it is. It's always difficult when you're in, if a specific sector is headed with new technological revolutions. But what I think is also a symptom of is the economy is still overhang with a lot of debt, and it's still sputtering, and that's the big task of Trump, to get that motor engine running again. And we'll see if that happens. But yeah, the debt burdens are weighing on the economy, and that's what you see. Stuff like Macy's, people are not spending their money, and that's what has to happen in this and next years to get this motor running again.
Yeah.
It's a big issue, and on top of that, you get deflationary forces like technological revolutions, and that's things we have to consider in the coming years.
Yeah, the U.S. is like at 106% debt to GDP now. I mean, we were at 65%. You know,
still rising.
Yeah, it's just, but that just goes to show you how much faster debt is rising in relation to real growth. And even the GDP, I mean, John Williams will tell you it's all phony, you know, in terms of the growth that we see. But I mean, it's really, when you look at everything, you know something big is coming, and it's just a matter of how it ultimately plays out. So, Nico, any last thoughts that you want to share with the audience before we said goodbye here?
I think the best investment opportunities at the moment are still the gold miners. If you look at the fundamentals, they've been slashing their costs, and the gold price is rising. So input is dropping and output is increasing. So their margins are going up, and the stock prices are beaten down. So I think that's the area where there's the most opportunity this year.
Yeah. Well, it's been a pleasure speaking with you, and I'm really grateful that you were able to come on and take the time to be with us here at Crush the Street. Nico, if people want to learn more about what you do and your website, please share some information on that.
Kenneth, they can come to secularinvestor.com and read through the site. They can pick up our specific analytics analyst reports, which focus on precious metals and also commodities. So it's our favorite topics at the moment, so that's where we're focusing on.
All right, everybody. We will be back soon and shortly. Stay up to speed. Visit us at crushthestreet.com for more news and updates. And Nico, again, thanks for coming on the show. We'll talk to you soon.
Thanks, Kenneth. Bye.